The billionaire investor Warren Buffett recommends index funds, which are generally considered one of the most successful ways to achieve financial freedom and retire early. The development of low-cost index fund ETFs and internet brokerages has made DIY index investing simpler than ever. Many newbie investors have not started investing because they don't know where to start. To begin and excel as a DIY index investor, you only need to understand a few fundamentals. 1. What distinguishes good index funds from fraudulent index funds? 2. Determine whether you should use a robo-advisor or do it yourself. 3. How to develop a risk-adjusted investment strategy and evaluate your level of risk tolerance. 4. The most effective method of diversifying your financial portfolios. 5. Selecting an online broker. 6. How to buy index funds. In this video, which also serves as an introduction to becoming a DIY index investor for beginners, I'll go into great detail about each of these fundamentals. Let's start with the basics. Index funds are investments designed to replicate an index of assets, such as bonds or stocks. Index funds are a form of investment product similar to a mutual fund or an exchange-traded fund, ETF, that seeks to deliver results comparable to those of specific indices like the S&P 500. Index funds is a straightforward and uncomplicated way to grow your money through investing. Just by duplicating the remarkable performance of the financial markets, index funds can switch up your investment into a substantial nest egg over time. And the best part is that you don't have to be a stock market guru to make money from index funding. Index funds has so many advantages, and this is why many investors prefer it. 1. It allows you to limit the time spent in investigating individual stocks. You can depend on the experience of the index fund's manager to invest in an index that comprises the stocks you want to buy. 2. There is less risk involved in investing. Some indexes incur hundreds or more of equities, and other investments you are less likely to incur big losses if any of the index's firms experience a setback. 3. Index funds can be used to make different investments. Index funds are available for the two primary components of investment strategies, stocks and bonds. However, you can buy index funds more limited and focus on specific parts of the stock market that you are interested in. 4. It is substantially inexpensive. Actively managed funds are more expensive compared to index funds. The index fund manager must purchase the investments that comprise an index. You do not need to pay extra for the stock decisions they make. 5. You will have a lower tax bill. Index funds incur lesser tax bills compared to many other investing options. Index funds does not require trading investments as often as actively managed funds. Index funds do not generate capital gains that could increase your tax liability. 6. Sticking to your financial strategy is significantly easier. With index funds, you may invest automatically each month and bypass short-term market fluctuations because you know you'll be a part of the market's long-term development. Before you invest in an index fund, you should evaluate your resources and priorities. Before making any investments, it's vital to understand your specific situation and personal goals. How soon would you like to retire, and how far away is that date? What are your financial circumstances and risk tolerance? Knowing this will help you decide how to invest in index funds and what role they will play in your life. Before deciding how much to invest, you must first decide how much funds you can afford to invest. Examine your finances and ask yourself the following questions to determine how much money you can afford to put aside for investing. 1. What is your overall take-home pay or income after taxes? 2. How much money are you currently spending on expenses? 3. What is your total debt, and how much do you pay per month? 4. What is your total net worth? This is the total amount of your assets minus your liabilities. By answering these questions, you'll obtain a thorough insight into your finances and also an idea of how much money you have to invest. Knowing your priorities will help you stay motivated and put your money to good use. It is vital to realize that risk cannot be ruled out 100% while investing. However, there are strategies for risk investing and learning within your comfort zone if you first determine your risk tolerance. Your risk tolerance is your degree of comfort and the number of funds you're prepared to forfeit when investing. 1. Choose an index. Index funds are a type of ETF or mutual fund that is structured to mirror the performance of a specific market index. Index funds frequently offer diversity and cheaper fees than actively managed funds, which is helpful to investors. According to a reputable independent investment advisor, index funds are constructed to watch and pursue a wide sector, such as large cap equities, emerging economies, broad indexes, or it may even be as detailed as monitoring significant tech firms. Indexes can take many different forms and serve many multiple purposes. Because of their design, index funds are already diverse. The S&P 500 or Standard & Poor's 500 is one of many substantial indexes that monitors the top 500 publicly traded companies. You can track a diverse range of indices by using index funds. The following is a detailed description of numerous additional key indexes categorized by market segment. 1. The New York Stock Exchange Composite Exchange monitors the movements in stock prices on the New York Stock Exchange. 2. The Russell 2000 Index monitors the performance of America's 2,000 smallest publicly traded companies. 3. The Wilshire 5000 Total Market Index monitors the overall performance of the stock market with securities based in the United States. 4. Dow Jones Industrial Average (DJIA) is an index of 30 blue-chip stocks from diverse U.S. firms. 5. The NASDAQ 100 Index monitors the top 100 equities traded on the NASDAQ stock market. Along with broad indexes, there are sector indexes linked to specific industries. For example, a country index that focuses on stocks in a particular country, style indexes that highlight rapidly expanding businesses or undervalued stocks, and other indexes that restrict their investments depending on their filtering mechanisms. 2. Before selecting an index to invest in, consider the following. Which industry? Every dollar you spend or invest is either a vote in support of an idea or cause that matches your values. If you want to protect the environment, you can focus on clean energy index funds. If you love technology or wish to help women-owned firms, index funds are accessible. Consider your risk tolerance once more. You can evaluate past performance and establish your risk tolerance before selecting a specific index. But as previously said, index funds are less volatile due to their diversity. Large cap indexes, for example, may have higher risk levels, whereas specialist bond indexes may have lower risk levels. Look for opportunities to expand. Do you want to invest in any new investment fields that are emerging? Consider investments that trade based on a specific loyalty, for example, international index funds. Confirm the company's market capitalization and size. For example, the term small cap, mid cap, and large cap all describe a corporation's market capitalization and market size respectively. Check the asset classes that the index funds track. The index fund can keep track of specific stocks, bonds, or commodities. Considering all of this, you can select the index that most closely matches your aims. Number 3. Select the appropriate fund for your index. However, because each fund and fund provider may have different expenses and portfolio designs, comparing each product inside a broad index is critical. Index funds at different companies may have similar goals, but there are various short and long-term costs to consider. The best place to start is by investigating the assets under management of a specific index fund, the price structure, trading flexibility and accessibility to the fund, and the experience of the managers who control the fund. Examine any minimum investment or account opening criteria for a particular index fund, such as the $3,000 investment requirement for the popular Vanguard Total Stock Market Index Fund Admiral shares. Typically, you can find at least one index fund that tracks the index you have chosen. You may have a few options for following well-known indexes, and if you have more than one index fund option for your index, ask some fundamental questions. First, which index fund closely mirrors the index's performance? Second, which index fund provides the best rates? Third, are there any restrictions or limitations on an index fund that would prevent you from investing in it? Finally, are there any further index funds available from the fund provider that you would like to use? The answers to those questions should make it easier for you to choose the best index fund for you. Number 4. Purchase index fund shares. You can open a brokerage account to buy and sell index fund shares that interest you. You may be able to open an account directly with the mutual fund provider that offers the fund. Signing up for an online brokerage account is one way to do this. To invest in funds manually, open an account with a brokerage firm such as Fidelity or Vanguard. You can also use a robo-advisor, such as Wealthfront or Betterment, which will invest and rebalance your portfolio on its own. If you want to invest in index funds but need help, you can work with a financial advisor who can guide you to the funds that best suit your risk tolerance and then manage those funds on your behalf. Again, consider fees and features when deciding which option is best for you to purchase index fund shares. Because some brokers charge a fee for their clients to buy shares of index funds, registering a fund account directly through the index fund provider is less expensive. However, many investors choose to keep all of their investments in a single brokerage account. If you want to invest in different index funds offered by several fund managers, the brokerage option may be your best option to keep all your investments under a single account. Irrespective of your investment goals, these are some factors to consider when choosing a brokerage. 1. What fund selections are available? 2. Are there any mobile apps available, and how do they work? How user-friendly is the platform? 3. What is the cost of trading? Examine the expenditure ratios in the prospectus to see whether there are any commission-free trading opportunities. The key is to create a plan that meets your goals while keeping costs to a minimum. Index funds, as simple and plain as they are not for everyone. Investing in index funds has a few drawbacks. You will never be able to outperform the market. Index funds will not allow you to demonstrate your talent as a skilled investor because they're just structured to replicate the market performance. You have no loss protection. Index funds mimic their respective markets in good and bad times, and if the market collapses, so will your index fund. You can always have different index funds and other investments to provide you with more options for dealing with some of these drawbacks. However, if you intend to use index funds, you must become acquainted with their limitations. And that brings us to the end of the video. Let us know your thoughts on what we've talked about in the comments section below. Don't forget to like, subscribe, and click on the notification bell to get notified when we post a new video.